Every now and again, we get some serious blue moon-like opportunities to invest your way into some of the stock market dividend gems out there at attractive prices, whether at fair value or best case below true value. Now today, I have 6 such opportunities to review with you that deserve to be on your dividend stock watch list, if not your immediate buy list, given their industry leadership, dividend reliability, and then most importantly, long-term ROI deliverability. Ultimately, all 6 of these dividend stocks that I'm about to mention today meet the Buffett-proof pieces of criteria that we all should be seeking out in our investments, from strong or rather well-known brand names, leadership teams that exude excellence and keep these companies growing, as well as balance sheets that are mighty clean, depicting little, if any, debt. So without further ado, I want to go ahead and kick right into gear with you and start with a true power player, Microsoft, ticker symbol MSFT, which may take you by surprise because it does have a lower dividend yield, but don't be fooled, because what it lacks in that dividend yield, it's going to make up for in sheer growth. And regardless, if you're a long-term investor, dividend yield just shouldn't be your sole focus unless you really need income right now. However, Microsoft made the hot list today because of a recent announcement of theirs when it comes to a quantum computing chip, which, if it really checks out, will rock the industry's current quantum leaders and really create fierce competition. But that will ultimately drive some serious returns for every investor in Microsoft. Now, Microsoft is also just Microsoft, this steady software power player that has and will likely continue to perform very well into the future. So as the stock has been lingering around $417 per share, which is down from a recent peak of nearly $450 per share, I think it's a buy opportunity. But the power of Microsoft sure lies within the long term there. So we're going to click into the 5-year chart where we're going to discover over 133% worth of share price appreciation. Scroll down a little bit with me and we're going to see an increased revenue flow here by over 15%, and net income as well is up over 21%. Scrolling down a tad more, we're going to find over 24% worth of an asset increase to hike Microsoft's overall total assets to over $512 billion to just $243 billion in liabilities. As for the dividend, we're going to click into Simply Safe Dividends to get a safety score of a 99. We will see again that lower dividend yield at 0.79%, but remember, Microsoft is the growth investment gem for us. So scroll down, we're going to get a payout ratio at a low of 25% after 18 consecutive years worth of dishing out those dividends and growing like crazy here by an average growth rate for that dividend at 16%. Now, if you really aren't so keen on adding like a Microsoft growth opportunity to your portfolio, I get you, and I got higher yielding oriented stocks coming up. The next 5 really do hit the mark. So first, we're going to check into the financial sector with JP Morgan, ticker symbol JPM. And as America's largest bank that has also become just a prominent player worldwide, well, we're going to go ahead and talk about JP Morgan here as one that's hard to ignore, especially when it falters to lower lows like it's doing right now, trading for $266 per share. That's down from almost $280 per share just days ago. But JP Morgan is another long-term pick for any portfolio, or at least should be. So let's click to the 5-year chart here to see that it delivered through on 96% worth of share price appreciation to shareholders. And of course, Jamie Dimon's baby just exudes health all the way around on all fronts, both in the income statement and balance sheet. So we can see plenty of revenue growth here, over 14%, to just about a net income growth there as well of 18%, which is spectacular. Now, scroll down with me to see $4 trillion, yeah, with a T, $4 trillion worth of assets to just $3.6 trillion in liabilities. However, being invested in JP Morgan for dividends means investing into a company with a 70 safety score, not too shabby, according to Simply Safe Dividends, of course, which also comes down to a 1.87% dividend yield, a 24% payout ratio. While it is a challenge for it to maintain a track record given evolving financial climates, JP Morgan nonetheless continues to have an average dividend growth rate here of 7%. Now, another name that is truly struggling right now, yet very deserving of your attention, is the one and only Caterpillar Construction, ticker symbol CAT, which I personally like because if there's just one industry that continues to boom along with the human race, it's Caterpillar, the world's largest manufacturer of construction machinery and equipment. So when the economy is booming, Caterpillar is soaring. Now, clicking into Caterpillar's stock chart, we're going to find that it slid from over $407 per share to just $349 per share, presenting, in my opinion, a great opportunity for long-term investors seeking growth in a surprising sector. Because clicking out to that 5-year chart, you're actually going to notice here that Caterpillar appreciated by 154%, which is even more than Microsoft appreciated during that same period of time. And better yet, if we scroll down, we're going to find an income statement depicting plenty of health, with net income climbing by over 4%, as well as a balance sheet that depicts assets trumping over $87 billion to just $68 billion in liabilities. Now, as for Caterpillar's dividend, let's click into Simply Safe Dividends together to find a dividend safety score here of a 93. And while the stock itself only boasts a 1.62% dividend yield, scrolling down, we're going to find a low payout ratio, which is a good sign. It's after a 32-year dividend streak. But here's the real gold, if you will, with Caterpillar. We got a dividend growth rate that's coming in averaging 10%. Now, investors, I of course have 3 more dividend stocks for you. But before I actually break them down with you, I actually want to share with you some metrics on the YouTube front, because as this channel has been growing, which thank you so much for tuning in every single video, I have noticed that 55% of you who are tuning in video to video actually are not even subscribed to the channel. So if that is you, someone who's tuning in pretty consistently, just not subscribed, I'm going to go ahead and ask you for that subscribe now. Join me on this journey to financial freedom. And of course, if you're getting value out of this video, I want to go ahead and ask you to tap on that thumbs up button as well. With that, let's get back to it here and cover one of America's go-to retailers. We have Walmart, ticker symbol WMT, which is the largest discount retailer in America. Not to mention, it's actually one of America's largest employers as well, making it a very reliable opportunity for investors over the long term. But more than that, in the most recent news that I think would appeal most to you is the fact that Walmart just increased its dividend payout by 13%, registering the largest raise in the company's recent history since 2013. Now, overall, Walmart has hiked the dividend for 52 straight years and remains a destination for millions of shoppers that are pinched by stubborn inflation like we're experiencing right now. Now, even higher income earners are shopping at Walmart, and it's just an amazing opportunity. So clicking into the stock chart, it's trading for $97 after recent quakes. It might be worth your attention right now. Clicking out to the 5-year chart, I want to have you take note of the fact that Walmart has also just outbeat some of the tech stocks out there that far too many investors, in my opinion, are chasing, with over 145% worth of growth here with Walmart. Scroll down, we're going to see that profits keep rolling in. Revenue is up by 6%, net income up by over 32%. And as for the balance sheet, we're looking at a company that maintains a clean balance sheet with $252 billion in assets to just $161 in liabilities. Jumping into Simply Safe Dividends, we're going to see that we have a dividend safety score of a 90 and a dividend yield coming in at 0.97%, which is actually like a tech investment for similar returns as one as well. But coming down to the payout ratio, which is at 33%, we're going to see that we have a 50-year dividend streak and a dividend growth rate here averaging 10% over the last 20-year period. Next up, I want to cover a personal favorite of mine for a dividend investment, of course. It's Lockheed Martin, ticker symbol LMT, which is the world's largest defense contractor, thus making it arguably one of the safest investments that you could possibly get your hands on as a dividend investor. Because let's just face it, governments are really operating off of sky-high defense budgets, and they're not likely to cut back anytime soon. Now, as for Lockheed, Uncle Sam is their largest client. With Trump back in office, we're already seeing the world's wars wind down, which hasn't necessarily been great for Lockheed's business model, given they really profit during times of war, but we can expect continued growth just as Trump is a fan of propping up the US military. Either way, let's click into the stock chart together to find that Lockheed has slid from $612 to its current share price of $436. And clicking to the 5-year chart, we're going to see plenty of reliability here over the span of time. Now, truth be told, I am kicking myself for not selling at the peak, only to buy back in, given that the peak happened just before Trump's bold statements on ending the wars. But either way here, we are now scrolling down together, and we're going to see just where the company stands in terms of its financial health. It continues to see revenue pour in, while the balance sheet remains squeaky clean with $55 billion in assets to $49 billion in liabilities after a 6% increase in assets. Now, clicking over to Simply Safe Dividends, we're going to find a safety score coming in at an 84, yet with a higher dividend yield than some of the other mentions on the list today, coming in at 3.03%. As for a payout ratio here, a bit higher at 46%, but loaded here with a 32-year dividend history and a solid 14% average dividend growth rate. Now, finally, an opportunity with NextEra Energy, ticker symbol NEE, which is the world's largest electric utility company, and in my opinion, will be a major utility power player well into our futures. However, if we click into the stock chart right now, we have an opportunity on our hands, as the stock price itself has been slipping and sliding with current economic conditions. Right now, trading for $70 per share. Clicking over to the 5-year chart, we're going to discover, though, reliability and predictability with NextEra Energy, as well as an opportunity if you buy it in the valleys. Now, scroll down, and we're going to find that we have a clean income statement as well, with a balance sheet that shows us just where the company stands. Very healthy, with 190 billion in assets to just 129 billion in liabilities. Yet the reason Next Era Energy is really the next era of dividend energy is because Simply Safe Dividends is rating this one a very safe 90. You're also going to reap the benefit of a dividend yield coming in at 3.23%. Now, scrolling down, we're going to discover a payout ratio here at 60%, but with a solid track record at 29 years worth of a dividend record. And then we have a 10% year-over-year average growth rate. Now, investors, there's all 6 dividend stock opportunities for you. I want to know your thoughts on each of them, so go ahead and let me know by commenting down below. Now, if none of these stock picks you think are worth it, but you have better picks in mind, also drop that comment down there as well. Be sure you're subscribed to the channel and be sure to tune in right here to catch the latest masters of the market chat and learn which dividend investing mistakes you should totally avoid. With that, I will catch you all in the next one.